Today's webinar is going to look at the value of financial advice. Some of you may have had financial advisors in the past. Some of you may be looking to work with a financial advisor, and some of you may just be sort of exploring what we do. So the idea of this webinar is to show you what we do, is to sort of show the value that we add to you and your family, and hopefully sort of show you how we can make your and your family's dreams a reality. So I am one of the senior financial advisors here at Flying Colours. I work out of the Bracknell office. I've got 20 years experience as a financial advisor. 10 years of that has been working for a bank. So when I work for a bank, the advice is restricted, whereas being independent, as we are at Flying Colours, we are essentially unrestricted in terms of what we can offer, so whole of market. Number of reviews online about us as individuals and also about the firm as well. So if you are looking to sort of understand more about sort of client experiences and what people do say about us, then feel free to have a look on sort of Vouch for, Trusted, Google reviews and so on. So that's myself. So for the next half an hour, 35 minutes or so, I will be explaining how we add value and what a financial advisor does. So there are a number of sort of queries that we'll go through. So we deal with a lot of successful people. There are a lot of successful people that do plan to fail sufficiently. Now that's for a number of reasons, whether it's time, whether it's other priorities in life. But we'll sort of look at the reasons around that. Obviously, DIY platforms and DIY investing now are becoming much more easily accessible. So we'll look at the pitfalls of doing things yourself without advice. We'll then explain what we do as financial advisors and give you some examples in terms of the value that we add, and also look at a fairly detailed cash flow modeling. So the idea is to bring to life an example case to show you how we put a client from where they are to where they want to be and how we improve that situation. There'll be a couple of case studies that we'll show through to give you an idea of the value from a sort of pounds and pence and also from a percentage point of view. And as Celeste mentions, there'll be a Q&A at the end to give you a chance to ask some questions, and hopefully we can answer those as best as possible. There will be an opportunity at the end to click on this QR code, rather scan this QR code. So if you do have a smartphone, you can scan this and it will take you through to one of our representatives who can obviously give you an idea of who might be suitable to speak to, whether it's myself, whether it's one of the other advisors. We have advisors all up and down the country. So without further ado, so let's have a quick poll before we begin. So hopefully if I can get the software to work properly, there should be a couple of very straightforward polls here. So just bear with me. There are two polls here. So the first one, if you don't mind giving us your input, is do you have a financial plan in place? So if you don't mind just clicking on here, we'll just see how ahead of the game you are. So I'll just give you a few more. Okay. So the results on here, I'm just going to end the poll, are pretty much as sort of fairly typical. So it's around 80% have a financial plan in place, about 20% if you don't. And it will be interesting to see here. I can share the results on here, so hopefully you can see that, about 80%, 20%. And I'm just going to bring the second poll up, which is, are you confident that your financial plan is going to deliver your goals? So just bear with me, I've got the same poll out. I'm just going to end that poll.
I'm on standby, Tom, if you'd like me to launch the second one.
I can. Oh, I got to go back. There we go. Right, poll 2. Here we go. So the second one here. So hopefully you can see that on there. That's the second one. So just see if there's a few more on there. Right. So fairly typical. So a lot of people we speak to have a financial plan in place, as yourselves do, around 80%. But around 64%, 65% are confident that it's going to achieve the objectives and you're going to meet your goals, which is very interesting. So obviously a financial plan not only gets you to think about your financial goals, but also shows you how we can get there and give you a financial roadmap. So an old sort of saying, which I'm sure you've heard of before, but a fail to plan is a plan to fail. So we need to have a plan and we need to have a process with which we can check that plan and bring it into reality. So Vanguard did a study 3 years ago around the value of financial advice. So Vanguard, I'm sure you would have heard of, a huge global investment company. And they looked at a global study around clients who had a financial advisor and clients who did not take financial advice. So everyone is very different. There will be extremes either ways, but the average client is around 3% a year better off net of any fees in terms of working with a financial advisor. Now, obviously, if you have more wealth, you tend to pay more tax, you pay higher inheritance tax and so on, so that it can be significantly increased for larger pots. But the average client is around 3% a year better off. Now, it's not a simple case of saying we will beat the current performance that you can achieve or you have achieved. It's a far wider, more complex picture than that. It's around the financial planning, not necessarily the investment management. So these returns are not seen year after year after year. They can quite often be 1, 2, 3, 4 life events that can make a significant impact, but the average is around 3% a year. So that's from Vanguard. There's also another study done in the UK, which was from the ILC. So they did a study back in early 2000s where they looked at a mixture of Brits. So some of them took advice, some of them didn't. So between 2001 and 2006, the average of the clients that had a financial advisor after 10 years were nearly £50,000 better off. And again, there's a number of reasons, all individual cases of how that was achieved, but ultimately it does work. We do add wealth to our clients. So there's some sort of headline studies. I just want to look at now sort of a number of sort of areas where platform arrangement online, Hargreaves and AJ Bell and so on, it is easier to sort of access these solutions. So one of the big sort of areas where things can be improved upon is getting the right level of risk. So there's two extremes in this. So the one on the left here is obviously being too cautious. So when we assess a client's appetite for risk, we look at their experience, we look at their investment horizon, which is probably the most important one. You know, how long do you have before you're going to need this money? And we look at sort of capacity for loss, other assets, you know, how reliant are you going to be on this asset? So by being too cautious, so potentially if you're a younger investor, longer to go, by being too cautious, sitting too much in cash, it will have a material impact when you get to retirement and when you get sort of through life in terms of what your assets will be worth and what they're going to be able to generate. And equally on the other extreme, if you're taking too much risk, and you may not even be aware of this, but taking too much risk at the wrong stage in life can have a huge impact if the wind changes. So a lot of clients will misjudge their requirement to take risk in one extreme or another. So diversification can also be a big impact as well. So it's very easy to look at what has done historically and look at the future and say, well, actually that's done particularly well, so therefore that's what I want to be in. And a good example of that is arguably the US at the moment. Tech stocks. There's been some absolutely fantastic performance, and it's very tempting to sort of see that and view that as what's going to happen going forward. And it's quite often the opposite. The things that are unloved and undervalued are actually quite often the things that do perform at a better rate. There is an example on this slide here of a very big fund manager who had, I think, over 100% growth in the 5 years up to COVID. There was a big pullback just post-COVID around 2001, and the fund dropped by 40%. So things that have done well, they have done well for a reason. They're taking a level of risk, which means that if it can go up that quickly, it can come down that quickly. So obviously don't put too many eggs in one basket and don't follow what has done well. Again, a fairly sort of important topic at the moment. We get a lot of queries around the budget, but tax planning, which is quite often unrealized by clients in terms of what they can do. So using the obvious ISA allowance, pension allowances, reducing income tax where possible, nil rate bans, lots of other sort of opportunities to avoid tax where possible. So we have a relatively complex tax situation in the UK and arguably globally. So it does present opportunities, but obviously as the rules change, which inevitably there'll be a budget next year, the next year, and so on, it's making use of those sort of opportunities, wherever they may be, to stay ahead of the game. So yeah, a lack of tax planning and not realizing what is available to us can have a fairly big impact around returns. Another area we could look at is sort of lacking patience. So the stock market is obviously, or can be, quite volatile. So it's holding on nerve when things are wobbling, reminding clients that we're looking for long-term growth. Short-term volatility is part and parcel of that, and people can be sort of fairly impatient in the short term. So there's a quote from Warren Buffett about the stock market being a device which transfers money from the impatient to the patient. So the graph here shows staying invested over a 30-year period. So it's a £10,000 investment, would have yielded around 56,000. If you had missed just 5 days of the best returns, and they normally followed large drops, the investment drops by about 16,000. You repeat that process by missing 10 days, 15, 20, and 25 days over a 30-year period. There's a significant impact on not being invested over a longer period of time. So there's a saying that we have, which is time in the markets rather than timing the market. So you're best to look at the horizon, look at the long term. The ups and downs will happen in the short term, but you're best to leave things alone. So it's trying to sort of make sure people are disciplined in looking at the long term and not making knee-jerk reactions. So this graph is very similar. The sort of greeny sort of turquoise line is remaining invested, and the purple line is sort of jumping ship when things get a bit rocky. You'll never time the drops and the increases perfectly. Even if you sort of avoid some of the downturns, you'll never purposefully sort of get in at the right time. It's more luck than judgment. So this sort of scenario is where a client has jumped out a few times, and the impact over a long period of time is pretty significant. We're talking 140% difference over that long period of time. So yeah, again, time in the markets rather than timing the markets. So trying to make sure people aren't making knee-jerk reactions and are making sensible decisions based on advice rather than sort of emotional decisions. It's quite easy to be overconfident. I think that's a fairly evident one at the moment. So particularly with the last couple of years, and I appreciate there has been a sort of a lot of the markets prior to that, but the last couple of years, there's been a lot of money made. It's been very easy to make money. Pretty much anything this year has made money. So there can be sort of an overconfidence and taking excessive risk without knowing within a portfolio. So it's just being realistic with our skill sets. Are we experienced enough? Do we know what we're doing? So it's just being honest with yourself to make sure you're not sort of taking an unnecessary level of risk, which could end up backfiring somewhere down the line. This is a quote from Donald Rumsfeld. So this was around the Gulf War, which I'm sure you would have be familiar with. I won't read it all out, but it's the last point. There's areas where people are aware that they don't know necessarily, what the areas are, the known unknowns, if you like. But there's a whole load of things that people don't know what they don't know. So I spoke to a client, a potential client 3 weeks ago. She's inherited a large sum of money. Now, the idea originally was to put some of that money in, £60,000 a year, into her pension over the next 7 years or so to build up a really nice pension fund. Now, unfortunately, we've just found out that she's taken out a very small sum from one of her pensions back in 2023. So she's triggered the NPAA. She wasn't aware of it. Scottish widows who she spoke to didn't make her aware of it. But because she's taken some taxable money out of her pension, she is going to be limited in what she can put back in again. So it's limited to £10,000 a year rather than 60. So the knock-on effect for that over the next 6-7 years is pretty staggering. So again, there are things that you perhaps should be doing, but there's a whole lot of things behind the scenes that you don't realise, and that's obviously where we come in. So just be careful on that front. So what is personalised financial planning? So it is very different to each person. Everything is tailored. So individual client needs, objectives will require individual advice. So it's being a source of professional expertise, having that experience and that sort of level-headed judgment to guide clients through. A lot of clients don't realise what they want going forwards. Some have got a very clear roadmap and they've got a very clear plan, but I would say the majority probably don't really know what they want to do going forwards. They know they want to retire, they know they want to be wealthy, they know what they want to pay the mortgage off, etc., etc. But they haven't really sat down and thought about it in much detail. So our job is to sort of think about, well, what will you need? What are you going to be doing? Are you going to be holidaying in Bognor Regis, Barbados? Are you going to be, retiring early, late? Are you going to help the children out? How are we going to do that? So it's really helping to uncover what is important to individuals. Obviously, the investment management part of it, which we don't do as advisors, is done by our investment team. So it's managing those portfolios in line with those risk-adjusted returns. So essentially making sure that things are doing what they should be doing. We're not in poorly performing areas, and we're maximising the returns we can within those risk profiles. There will be some curveballs as well. Markets don't go up by 7% a year. Obviously, if that did happen, our lives would be, very easy to sort of plan and predict. But there's a lot of curveballs, whether that's, longevity, whether that's, changes in inflation, changes in performance, but it's being prepared for those sort of events that may or may never happen. It's just making sure that we're sort of staying ahead of the game and, factoring those results. People's lives change, as I said. Sadly, people pass away. Sadly, people lose their jobs. Their health can deteriorate. So again, it's just making sure that when those events do happen, that we have a plan to protect those and make sure the plan is still on track. It's obviously quite time consuming as well. So if you are, a genuine investor and you may have spent some time doing this to know all the ins and outs of what's going on in the world, what's going on with the investment funds you've got, the shares you've got. It's a full-time job. So again, it's a very time-consuming thing, and most of our clients have got very busy lives and other things they'd rather be doing. So it obviously saves quite a lot of time on that side of things. And obviously going forwards, emotional support and guidance. So we speak to clients 3, 4, 5, 6, 7 times a year. Sometimes there'll be certain events that there'll be a lot more support required. So it's offering that support going forwards. So in terms of how we plan for the future, cash flow modeling is a really important tool to visually demonstrate what a financial plan might look like for a client. And I'm going to go through an example here. It's a fairly high level, simple example, but this would be tailored to individual clients. So this scenario here will just give you an example. So based it on a fairly simple solution. So a client's age 50, single, annual salary £125,000 per annum. So just to highlight that, so if you earn obviously over 50 odd thousand pounds, you pay higher rate tax. If you earn over 100,000, you start to lose your personal allowance as well. So in this scenario, this client is paying 60% tax effectively between 100 and 125,000 per annum. 2 children. There is a personal pension with £200,000 in, risk level 5. Level 1 is essentially the lowest risk, level 10 is the highest risk. So this is somewhere in the middle as it stands. Annual management charge around 1.5%. And there is a workplace pension with around £50,000 in. And this has a risk level of level 5 again, so somewhere in the middle. And salary sacrifice being matched by the employer, which is 5%, so 10% in total. Now, there are some cash savings. So cash savings, we assume on our cash flow modelling, it may be slightly higher at the moment, but it could be slightly lower in the future. We assume an average of around 2.5%. And the current expenditure for this client is £4,000 per month. Now, we'd normally go into a lot of detail with what is required, what the fixed outgoings are, what the sort of nice to haves are, but just for the simplicity of this, £4,000 per month would be the expenses. And we've also factored in some holidays as well. So holidays are £5,000 per year. And I've also included in this scenario gifts to the children. So this client wanted to gift some money for the children in around 10 years' time. So £60,000 for house deposits. It could be weddings, it could be education, but in this scenario, I've modelled house deposits. And this then shows what this client requires. So the black line here is the income requirement. So this black line, which is going up and down, this is the income requirement of £4,000 a month. We've then got these small spikes here, which is replacing the car every 5 years, an extra £10,000 for this individual, and then a sort of large sum, £60,000 for the children. And we include inflation in these. So obviously there's £60,000 now. This may well be 65, 68, 70,000 by the time it's required. So we do adjust it for inflation. So the blue bar here is the income. So this is obviously a salary, and then the income requirement drops in retirement because £3,000 is required. And there will be a couple of spikes here in terms of future car purchases. When the client gets to age 80, unlikely to require a new car, and therefore expenses sort of reduce down, as do holidays. Plan to sort of do long haul flights is going to reduce, and this is the requirement going forwards. So what does this look like based on the current situation for this client, bearing in mind the previous slide? So this is the current situation. So these different colors will represent different assets. So we've got the workplace pension, the private pension, and we've got cash savings. So if you can recall, £200,000 in cash, £200,000 in a personal pension, and £50,000 in a workplace pension with funds going through. So whilst this client is working, the assets will be increasing. This drop here is when the £60,000 gift is made to the children for house deposits. Again, there is then an uptick again, and at retirement, we will then start to draw this money out, the £3,000 a month, plus obviously the holidays and the car, etc. So this client, based on the current scenario, and this is based on average returns, which is around about 6%, I believe, for a risk category 5. Average longevity, which is around 90, and also average inflation, which we use a historic average for inflation of 2.5%. I appreciate it's been far higher in the last few years, but the long-term average is around 2.5%. So in this scenario, the client, if we stick with the status quo, may have enough, but there is a danger of around 91. If the client outlives 91, then we go into the red territory, which is you've run out of money. So obviously not an ideal scenario. So yeah, we refer to these as red tails. So currently this client is fairly close to the wire, and there is a reasonable sort of chance that if things don't quite work out, if inflation's higher, if performance is slightly less than predicted, there could be an increased risk of running out of money earlier. So current situation. Then we've got post advice. So the advice on this case is to invest £150,000 of the savings. So retain 50 as an emergency fund and sort of short-term funds. Invest 150,000, and we would put that into a mixture of pensions, investment ISAs, and then a general investment account. What we tend to do is then move money year after year into a pension, into an investment ISA, and the idea of that is you're obviously getting tax relief, and also it's increasing growth, because obviously in terms of performance, an investment generally performs better than cash. So increase the level of investment, and also there was a possibility to increase the payments into the workplace pension. So it wasn't being maximised. The client had some spare surplus funds each month, so increase to the workplace pension, and the risk level was actually inappropriate for this particular client. So after the risk assessment, after looking at the client's age, the likely retirement age, we actually assessed this client should be taking a level 7 rather than a level 5. Therefore, more shares, more growth, and the end result, as you can see, is quite a lot better off. So this client actually getting to retirement age actually ends up not only not running out of money, but actually having a pretty reasonable size estate if they did last till 100. So, a fairly significant increase based on likely sort of averages, average returns, average inflation, and longevity. So what does that mean? So actually, this client can retire earlier. So the previous slide shows if he retired in line with the sort of plan A. So actually, we can potentially look at this client retiring age 60. So by doing that, obviously, there's going to be more of a draw on the pot. It's going to have to last longer, but it does obviously, enable this client to retire earlier. Now, based on the kind of average scenarios around longevity, performance, and inflation, the pot will probably last for around 91. But again, it does shave off quite a few years of work. So obviously that puts the client in a more preferential position. So that's obviously good news. We then look at some fairly extreme events as well. So the likelihood of this happening is very slim. This assumes that inflation is 5% for the next 30 or 40 years. So highly unlikely, but again, with the current sort of recent spike in inflation, which has worried people, we are running with higher inflation at the moment. But it does have a huge impact on assets going forward. So in that scenario, pre-advice, so leaving things as they are, the client, if they were to retire, would actually run out of money age 78. So again, a fairly extreme result, but it's just to illustrate if inflation is particularly high, it will have a very material impact on the client's longevity in terms of planning for retirement. And then post advice. So again, it does improve the situation, but again, because inflation is higher, it does mean the pot runs out earlier. But it does go from, I think it was 78 before, up to about 87. So 10 more years worth of retirement income. So it does increase the situation, but again, there is that sort of risk long term that the pot could, in theory, run out. And then this scenario here again is very pessimistic, but we obviously we want to sort of have an idea if the growth rate was far less than is likely. So the growth rate would be half of what we expect. We do get bad years every now and again. Every sort of 5-10 odd years, there's a market correction. Whether it's a banking crisis or a house price crash or whatever it might be, there are events, but this assumes that over a very long period of time the growth is half what we expect. So again, it's very pessimistic, fairly unlikely, but again, we just want to illustrate what that impact would have. So in that scenario, because the growth has gone from sort of 6% down to 3%, it's sort of just about better than cash, but it hasn't made a significant impact. So there's a slight increase, but it's not going to be quite as helpful over the long term. So hopefully that illustrates how the cash flow can illustrate how much better off we can make clients. And just to remind you, this is inclusive of running fees within pensions, investments, and it also includes the advice fee as well. So it actually shows you how much better off you might be. So moving on to the next part. So That's the growth rate, sorry. So yeah, some individual case studies. So again, I've got 3 examples here in terms of what it might look like for this client. Now, obviously everyone's different, individual needs, individual family setups and so on. So again, this is just an example of something we might be able to look at. So Ashley here is 50 years old, hasn't accumulated that much. She's got £50,000, but she is a higher earner, so she's paying a lot of tax. So the most valuable interventions in this scenario were fully taking advantage of the contributions with the workplace pension, which, believe it or not, some people don't fully, don't fully do. So making use of those, but also redirecting some of the funds she had in her ISA into a pension instead. So getting that higher rate, that 40%, potentially even 60% tax relief. So the compound impact of that over a longer period of time is pretty significant. So it's only 1.3% or 1.33% per annum, but actually the impact over a long period of time works out as over £250,000. So it's a pretty significant uptick in terms of returns and wealth. David here is a little bit older. He's 60 years old. He's managed to accrue a reasonable pot here, 1.69 million. Fairly cautious investor, but didn't really realise within the portfolio that he's got quite a high level of risk. There was a lot of equity in there, and certainly being closer to his retirement age and wanted to draw funds out, he's taking a lot of risk on unnecessarily. So the most valuable interventions around the advice was to look at the asset allocation, to spread the investments much more, to not overexpose himself into sort of any particular areas, and sort of reduce down his risk profile. It wasn't necessary to take the high risk he was taking, and also to give him advice as to how best to withdraw funds out from his investments, pensions, in a tax efficient manner. So reducing the potential tax going forwards and the impact over that. Again, sounds small as a percentage, 1.26%, but actually over a full retirement, the impact is over £900,000. So yeah, so it has a very, very big impact by making those adjustments. And the last one on here is David. Sorry, beg your pardon, it's Peter. So Peter is 57 years old. He's managed to accumulate a fairly healthy over £2 million. Recently sold his business. He has done some sort of investments himself, but he has been a bit worried and sort of, maybe have some sort of knee-jerk reactions to sort of market conditions and what's been sort of going on in the world. And he's worried about running out of money. So he's perhaps been a little bit more frugal than he perhaps could have been. So we can actually map out and show him what is likely in terms of his expenses. Now, we don't know for sure, but if we use reasonable assumptions around longevity, inflation, performance, and so on, we can actually show him that he can spend far more than what he could have done, out of his own sort of, thought process. So encouraging greater spend in retirement. So reduce the estate, reducing the burden for the inheritance tax going forward. So obviously with the change of legislation in the last budget from 2027, pensions will become part of the estate. So rather than sitting on a large estate, large pension, and ultimately paying, a massive amount of tax, the next generation is actually drawing it out at a younger age, enjoying it, maybe gifting it. And therefore the impact is pretty significant upon that. So it's around 3.5% in terms of annual increases, which is £1.2 million worth of additional returns around the sort of tax saving and financial planning. So again, hopefully that makes sense around how we've sort of increased these individuals. As I said, you individually will have your own requirements, your own situations, own family dynamics, and so on. So there's not a case of saying, well, people do this and people do that. Individual needs are obviously bespoke, tailored advice. So the idea is to have a chat with one of our advisors. Feel free to get in contact, whether it's myself, whether it's one of the other advisors. We've got advisors up and down the country. So a fairly informal sort of 15-20 minute chat. Obviously no obligation to proceed with anything, but the idea is to click on this or take a picture of this QR code here, and come through to one of our representatives, and you can then get in contact with one of us. So I think there is some Q&As now, Celeste, I
Yes.
believe. So
Yeah.
I don't know if you've managed to gather a few.
Yes, yeah. So thanks very much, Tom. Just before we do go on to the Q&A, I would encourage you to take advantage of this opportunity to have just a very informal chat with Tom or one of his colleagues. This evening, we've been talking in very general terms about how financial planning can help you identify and achieve your dreams. But actually, a one-to-one conversation with an expert is going to be more tailored to your situation and your dreams. So I'd really encourage you to just book in that 20-minute chat. The QR code there will take you through to our client relationship team, who have access to Tom's calendar as well as the calendars of the advisors, and they'll be able to book in that 20-minute chat at a time that's convenient for you. That doesn't obligate you in any way. There's no pressure for you to go forward with this. If you do decide that you would like to carry on the conversation, you'll still be entitled to a free, no obligation initial consultation on a more formal basis. But as I say, this is a nice starting point, I think, to get your questions answered and find out a bit more about how financial planning can impact your situation. So in terms of the questions, as I mentioned at the top, we did have a few questions come in when people registered. So I'm going to start with those, Tom. So the first question is, are you able to include examples of how you would approach financial planning with younger clients to show how they can backwards plan to work out the optimum amount they should be saving into a pension? So to grow a pot of X, they need to do X by Y age, for example. Sorry, hopefully I've explained that.
Yeah, no, that makes sense. I mean, I don't think it really makes a difference whether you're 20 or whether you're 60. I mean, to be honest, we probably have more, we can add more value the younger you are, because the younger you are engaged with this, the more impactful it will be. But yeah, we need to start with a figure. We need to start with a figure of what you want in retirement, and then we can work backwards in terms of what is likely to be required. Now, as I said before, we can't predict exactly what you need to save, because we don't know what all the variables are. So whether it's, growth rate, 3, growth rate 5, it's going to have an impact. But we can give you an idea based on average performance, average inflation, average longevity in terms of what you should be doing. So yeah, we can engage with anyone at any age to give you an idea. Obviously, the further away you are, the more the variables will have an impact. But yeah, we always will work backwards in terms of, what do you need, and then sort of work out whether it's viable or not. So yeah, it doesn't matter how old you are.
And I guess that's the beauty of the cash flow modelling, isn't it? You go back or forward and look at all
Absolutely,
different scenarios.
yeah. We can sort of show you what would impact on the current situation if you saved an extra £20 a month, or £100 a month. It will all have a big impact. So yeah, we can show you. And the cash flow we do, to be fair, is we do it annually. So whilst we obviously do one sort of initial piece of advice for clients, we revisit this all the time, because the situation changes, sometimes for the better, sometimes for the worse. So it's just having an impact on what's happened, and how does that affect my plan.
Yeah. Okay. So the next question that's come in is, when commentators discuss sequence of return risk and longevity risk, is this not the same thing? Is it effectively having the potential of running out of money before you die?
Yeah, so I assume sequencing risk is that's not to do with the volatility of taking money out when markets are being volatile. So let me just explain that. So what we tend to do, certainly when you're drawing money out, in retirement or close to it, we tend to put sort of 3 pots. So we have 18 months in cash, 18 months in a sort of very low risk portfolio, which will have modest returns, but not much in terms of fluctuations. And then the bulk of it can then sort of remain invested. So as the markets are fluctuating, if there is a period of time where it is going down, you're not taking out of that pot, you're taking out of the cash and the very low risk part. But yeah, the way I'm sort of hearing the question is basically when things aren't performing as well as they should do, yes, they'll have a negative impact. And yes, if you live longer than expected, it will have a negative impact. So yes, they will all have an impact, but they'll vary depending on when that happens, and particularly with say a market crash. If it happens in the early years or the later years, it has more of an impact earlier on than it would do sort of later in retirement. So we can model all those scenarios.
It's all about mitigating the risk as best you can.
Absolutely, yeah. We don't know what the future holds, but we can give you an example of if A, B, C, or D happens. Ultimately, all these cash flows that we do, they never are exactly what's going to happen, but it's just looking at all these different scenarios and saying, look, you're pretty secure, or you're okay, but all things are going to have to work out, as we predict. Most clients have some sort of red tails. If you live till 100 and inflation's 5% a year, a lot of us are going to be in trouble. But it's a very extreme event to happen. But it's nice to know, I'm pretty secure, or actually I might be able to retire early. That's a very big impact on the modelling, as a lot of clients don't realise actually they can retire 3 years, 5 years, 2 years prior to when they thought they could. So if we can illustrate it, then it's obviously a good thing.
Or like Peter, actually be a bit freer with spending. What a great
position
to find yourself in.
Yeah.
Okay, so I think I can sort of predict the answer to this, but the question is, I'm not sure what I want in 10 years' time. Can I still do financial planning?
Well, yes. I mean, some people have got a very clear vision of what they want to do. They want to retire at 60 and, buy a narrow boat and all the rest of it. A lot of people, I think most people, they just want to have some sort of long-term plan. They're not quite sure what it's going to be, but our job again is to kind of try and get a little bit of an idea of what that might look like. Now, all of these things are obviously up in the air. They're not, exact plans for life, but it's just getting a plan. So we'd go through the outgoings, have a look at what they're spending now. Is retirement going to look the same as what you're spending now? Is it going to be more expensive? Is it going to be cheaper? So we have a plan, and then things will change, and then we just adjust what's required. And the closer you get to retirement, the more you'll realise what you might want to do. If you're 30 years away, then yeah, absolutely, you don't know exactly what you want to do and where you want to be, but it's just having a plan and then revisiting that regularly to make sure you're on track with that plan, to sort of make sure you're in charge and you've got a robust plan in place.
Yeah, and so the next question is related, and that is, what if my circumstances change dramatically? Isn't the plan just a waste of time?
Well, I mean, there's the saying we had in one of the slides there, fail to plan is a plan to fail. But yeah, ultimately plans do change. So we don't have a crystal ball. If we had a crystal ball, if I knew how long people were going to live for, what inflation was going to be, all these circumstances, our job is really easy. And things, it's a constant change of, this is where we are now, this is where we are potentially in a better position or a worse position the next year. Markets will change, your financial situation will change, relationships break down. It's just having a plan to begin with and then reassessing that on a regular basis.
Yeah, which is the benefit of the regular reviews.
Absolutely, yeah. That's where the real value is. It's not just a sort of a kind of a one and done, a golden shot and everything sorted. It's the ongoing advice. That's where the value is over time.
Mm-hmm. Yeah. Okay. So unless I have any other questions come in, I think this will be our last one. And it's to do with commissions, actually. So this is asking, don't advisors get commissions for making recommendations? And if so, why would I have to pay a fee?
Okay, well, we used to. So I started out 20 years ago. So yes, we used to, is the long and short of it. So the regulator at the time, the FSA, outlawed commissions from pensions and investments. 2012, I think it was. And the reason for that is, when we used to get introducer fees, they used to differ. So if Scottish Widows or Royal London or Aviva were paying more than another, they could be in theory biased to go with one provider over another. So what we find these days is those old plans that were pre-2012, they actually have a much higher running cost, because they used to pay commissions out the back door. So even though the commissions have gone now, they still have those higher running charges. So nowadays, it is very clear what we charge for. We charge for advice. It's completely impartial. It doesn't make a difference whether we put you with option A, B, C, X, Y, and Z. there's no bias for us anymore. But yes, we don't get any commissions. That's outlawed. And yeah, it does make more sense than what they previously had. So yeah, there's no commissions, no introducer fees, but it's very, very transparent. Part of the regulation now is we have to be very clear what is for the running charges of the plan. So you'll pay, obviously, an administration fee for your provider. There'll be a fund fee, whichever fund you're using, passive, active, and so on, and then the advice fee. So they're all very separated out and very clear now. Or they should be very clear.
Lovely. Okay. So I think that's all the questions that we've had in. So thank you, Tom, very much for presenting this evening and tackling all the questions. Thank you to everyone who's joined us. You will receive an email tomorrow with a link through to a recording of this, so you'll have the opportunity to review but also share this with friends, colleagues. The next webinar that we are running is going to be a week after the autumn budget on the 3rd of December. We've purposely left it a week until after the budget so that actually we do have an opportunity to digest what has been announced and what the impacts are likely to be. So details of how to register for that will be on the email that comes out tomorrow. But for now, thank you everyone for joining us, and I hope to see you again soon.